You're going to buy this property for, let's call it $200,000, and you can rent it out for $2,000 a month. Well, all this $2,000 in rent is not going to be your profit because you have expenses to pay. What are your expenses? There are 5 main expenses you have to think about as a real estate investor. That is, number 1, your property taxes. Number 2, your insurance. Number 3, your maintenance. Number 4, your management fees. And remember, even if you don't have a property manager, you still want to factor in a management cost because you have to factor in your time as well. And then you have number 5, your vacancy cost, because the reality is your property is not going to be fully occupied 100% of the year. There will be times where tenants move out, so you want to factor that cost in there. Once you get this number, this is called your NOI, your net operating income. This is your profit, assuming that you have no mortgage. If you get a mortgage, you're going to subtract that number from your NOI to get your profit. But this is how you run your numbers, so let's do it. So if you rent this property out for $2,000 a month, let's assume your property taxes are $300 a month or $3,600 a year. Your insurance costs are roughly $150 a month. You have to pay maintenance costs of $200 a month. I put this as 10% of the gross rent. That way, even during the months you don't have a maintenance expense, you could put that $200 aside. That way you can cover bigger expenses when they happen. Management costs, I put at $200 a month, which again is 10% of the gross rent. You can sometimes find it even cheaper than that, but we're gonna go with the 10% number here. And then I added a 10% factor to vacancy as well. So I took 10% of this as $200. I like to be generous with my expenses because if I make more profit than I expected, well, I'm not gonna be upset. But if I make less profit than I expected, now I'm going to be a little bit more angry. That's why I like to be a little bit more generous with my expenses. Now, when you add all these up, if I do my math correctly, it looks like it's going to be $1,050 in my expenses. So my NOI, my net operating income every month is $950 a month. Now, if I take this number and multiply it by 12, this means that my annual income is $11,400 a year, assuming that I don't have a mortgage. We'll do the mortgage calculation in just a minute. But is this a good deal or a bad deal? Is this a good return or a bad return? And this is going to depend on you. This is where you want to take a look at your ROI. And in commercial real estate, it's called the cap rate. All this means is what is your cash on cash return, assuming that you bought this property all cash. So the way you calculate that is you take this NOI number, and you're going to divide it by the cost of acquiring the property. In this case, it was $200,000, which means when I take $11,400 divided by $200,000, I get a little bit under 6%. It's actually 5.7%, which means it's a 5.7% cash on cash return on my money. I'm going to put in $200,000 of cash, and I'm going to get a 5.7% yield, dividend, profit, NOI, call it whatever you want, based off my $200,000 investment. Is that good? Is that bad? It's going to depend on you. For me, I like to look for a minimum of 7% cash on cash return, just because that's what I look for. Some of you might say 4% is good. Some people say 2% is good. Others will say I need a minimum of 10%. That's going to depend based off of what your goals are, what your risk tolerance are, how involved you want to be. But for me, I look for a 7% number. Now, if you have a mortgage on the property, you're just going to follow the same analysis. Let's assume that you put 20% down, which in this case would be $40,000. That means you got a loan for $160,000. And now once you have this $11,400 of NOI, you have to then subtract the mortgage and see if you're still profitable. If you finance the other $160,000 at a 7% mortgage rate, well, now your monthly mortgage payment will be a little bit over $1,050 a month, which is more than your NOI, which means you're gonna lose about $100 a month owning this property with a mortgage at 7%. But if you were to put down 30%, well, now you are slightly positive, which means in order for this deal to actually make sense based off of a 7% mortgage rate, you're gonna have to be willing to put down at least 30% or get a cheaper price or were to increase the rent. That's the type of analysis you have to run, and then you have to find what is the right percentage return for you to actually justify you making the investment. For some people, it's going to be higher, others will be lower. You have to find the right investment opportunities for you based on what your personal goals are. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.